Welcome to the Best of U.S. Investors, Two Regular Guys show. I'm Trent, and this is Mark, and we are a part of Best of U.S. Investors, and we're going to jump into a bunch of cool stuff today. So let's get going.
So, Kent, Trent is a little under the weather today, so apologize for any of his coughing, but he's going to try to push forward like the trooper that he is. And I'll talk a little bit, and if he feels good, we got some other things regarding shipping coming up. I want to talk a little bit about market capitalization, and especially the S&P 500 market capitalization, and go into a little bit of why we see the markets going up, but we don't necessarily see, all the stocks doing it. Okay, last week we talked a little bit about market breadth, and market breadth says, how many stocks are advancing versus how many are declining, and we showed, in the market breadth was really kind of negative, and even today, it being Wednesday, 31 on the New York Stock Exchange, 31% of the stocks are advancing, while 65% right now are declining. So that's our market breadth.
Well, Mark, let me interrupt real quick and ask you this question. Why this subject? What spurred this on?
Well, for me, it's the hype of when you watch the financial channels, and I want to pick on them at CNBC or even the nightly news, you see all new high in the S&P 500, all new high in the NASDAQ. Okay, and so if you're not in one of these S&P 500 indexes, and you might be picking individual stocks, you're like, well, how can this be? Okay, how can the S&P be up, 20-some% this year, and I'm up too? Okay, if you're not in the S&P 500. And so I wanted to go into it a little bit of why that is, and actually some of the history of when we get as high as we are, as far as concentration of certain stocks, what happens usually in the market. And just, as a couple regular guys talking, we want to be, aware of this so that we're not chasing the market and getting a rug pull at some point.
Yeah,
which
cool.
could happen. So we'll talk a little bit. So when the S&P 500 being weighted by the market capitalization or the market cap, this means that the influence of each stock in the index on the overall index price is proportional to its total market value. Okay, so what does that mean? Okay, well, market capitalization is calculated by multiplying the company's stock price, and let's say Nvidia. What's Nvidia right today? I don't
know. Hold on one second. I'll tell you.
All right. Well, let's just say
to 130.
130. Okay, $130, and then you times that by the amount of shares outstanding in the company. So the higher price you have, with the more shares you have, the higher your market cap is. That's why you see Nvidia and Microsoft and Apple and these guys have high market caps. So a company with a higher market cap has a larger influence on the S&P 500's movement compared to a company with a smaller market cap. So I don't know who the number 500 is in the S&P 500, but I can tell you that if their stock price goes up 4% in a day, it probably barely nudges the S&P 500. Whereas if Apple or Nvidia or Microsoft went up, it would really make the market move up, and vice versa, make it go down. So companies with larger market caps matter more. So since larger companies have a bigger weighting, their price movements have more significant impact on the overall S&P 500 movement. Okay, so for example, a 1% increase in stock price of Apple, which is a large cap company, okay, will affect the index more than a 1% increase in the price of the number 500 company in the S&P. Because large companies dominate the weighting, the S&P primarily reflects the performance of these large cap stocks. This doesn't necessarily represent the performance of the smaller companies in the whole index. So the large caps can dominate, and it makes an illusion that the S&P, if they're going up, that the S&P is going up and that everyone within the S&P is following suit. And that may or may not be. Mm-hmm. So what if the top 10 companies in the S&P index had a combined market cap of over 35%? So if the top 10 holdings in the S&P did have that, and let's say they do, and in fact they do, it signifies I can't talk today. A
That's all
highly
right.
concentrated index with strong influence from a smaller number of companies. So the S&P becomes more sensitive to the performance of these top 10 companies. Okay. A significant price movement in any of these companies will have a more substantial impact on the overall index movement compared to a less concentrated index. Okay. Let's just say the equal weighted index, okay,
Hmm.
which is the RSP. So the index becomes more susceptible to specific sectors if these top 10 companies belong to those sectors. So let's take example where we have the top 10. Most of them are in technology.
Yeah.
Okay. So the technology sector is way overweighted in the S&P 500. So if we have a blip or a rise in the technology sector, that's going to affect the outcome of the S&P 500. So the S&P 500 does not accurately reflect the performance of the broader US stock market if a specific sector is heavily weighted in the top 10. We have 11 sectors in the S&P, and if the top 35, the majority of them are in the technology sector, that's the way the market is now weighted and tilted. Okay. So a high concentration of market cap, say greater than 35% in the top holdings of the S&P 500, can be a double-edged sword. It can amplify gains if those companies perform well, but it can also magnify losses and increase volatility. So why does this matter? Why does this matter? You know? Okay.
Absolutely. I mean, if technology is all the rage and the capitalization of each technology company in the S&P 500 escalates, it overweights the movement of the S&P towards technology, which drives the market higher, which
Absolutely.
instead of being a diversified 500 stocks or industries, it becomes a really consolidated
Yeah.
situation.
So to feed on that, which was correct,
Yeah.
the top 10 mega cap companies in the index account for over 35% of the entire market capitalization of the S&P 500 right now. And that's compared with 25% during the 1999-2000 tech bubble and an average of 20% over the past 35 years.
Okay.
So this means that money deployed into the market cap weighted S&P 500 is increasingly a wager on the health of just a few companies, with the fundamentals of the other 490 carrying less weight.
Go back to the comment about during the tech bubble. What was the percentage?
25%.
25.
Yep.
And today it is 35.
35, greater than 35%.
Is this because more capital has been leveraged capital has come into the market since the tech bubble? So money
Well,
printing?
I don't think percent wise it matters. I think it could be money printing. It could be the fact that we had such lower interest rates, for such a long time. It
Yeah.
could be the fact that people are just hyped about certain companies and technologies out there right now.
Hmm.
Let's look
Okay.
at. Well, here, let me show you a chart. Okay,
Okay. Let me share your
so
screen. Go
share my
ahead.
screen, and this one's a little dated, but it'll give us the point.
By the way, Nvidia is at 123.84.
Oh, all right,
So
we'll
a
go by
little
that.
off what I thought it was.
So this chart is from Amundi Asset Management, and this goes to 2023. But so the S&P 500 concentration is at its highest level, and this was back in 2023 in over 30 years. And at that point, it was at 31.9%. Now we're at 35% up here.
Wow.
Okay, so you can go and you can see in the year 2023, the contribution is 96.5% S&P performance. So you can go, they have it all broken out, and they have, basically the weightings of everything. But you can see here was the dot-com bubble. We got
Mm-hmm.
up, in the 20%, boom. Then we climbed up. Well, no, this was dot-com right here,
Yeah.
boom. Okay, this was the 87 bubble right here. Then we came down, and here's 08, where we went up, boom. Okay, and then we had a little glitch, in 13, 14
Yeah.
down, and now we've come back up. You can see where we are. Well, actually, we're way up here now, but
Yeah.
it's unprecedented where we are as far as market cap and concentration of 10 top companies. And in
Right.
fact, the top three companies are over 20%, okay, of the market
So
capitalization.
that's Apple, Apple, Nvidia,
Microsoft.
Microsoft right now.
Yep.
So those
Yep.
three are really the pin that's holding this thing up
Yep.
in a really big way.
Yep.
Okay.
So
Wow.
also, it's something you need to think about. According to Morgan Stanley, and they put out all kinds of information, the market cap weighted S&P 500 index, or the SPY, as a whole, has a forward price to earnings ratio, this is forward, of about 19. The top 10 stocks have an average ratio of 28, and the top three average 66. Okay.
And what
This is
that,
a risk. This
just
is a
so
risk.
people
Go
understand
ahead.
PE,
Right. That's forward PE
forward PE, this is the expectations of what the
guidance.
price to earnings will be. And so it's
Right.
a basically you're paying. So if it's 29, you're basically paying, I've always interpreted as you're paying for the earnings from
Forward earnings.
29 years from now.
Yeah. Yeah. Forward earnings. Yeah.
Forward earnings. So
Yeah.
you're
So,
okay.
and think about what's the average in the S&P right now. It's 18, 19.
Yeah.
Okay. So we're talking 28 and 66. Okay. So if
Yeah.
that means anything to you, and I hear a lot of people say, oh, it's different this time. But, in
Yeah.
my 40 years of watching markets, these numbers don't change. And it's different this time, just ends up in the same spot, you know.
Right.
And I'm not even going to elaborate on what that spot is because I know where it's at. But
Yeah.
people do fall in love in stock. They fall in love with Tesla. They fall in love with Nvidia. Okay. My number one rule is don't fall in love with a stock because it doesn't care about you.
Right.
Okay. And we may see that, coming up at some point. But anyway, this is a risk because rich valuations are dependent on low interest rates. Okay. Which is what we used to have. And that tends to make these projected values of these companies, future earnings, look more attractive to investors, just like you
Right.
said. Okay.
Yeah.
Should the Federal Reserve keep policy rates higher for longer, which I think they're going to do? Okay. Everyone else is thinking now they're going to, they're going to drop. Well, we were supposed to have what, 6 rate cuts? It's
6 or
already
7.
almost 5. Okay. We've
Yeah.
had 0. Okay. But anyway, should they keep policy rates higher for longer? Okay. The index may be more rate sensitive and subject to greater volatility than many investors assume. U.S. stock market performance has increasingly been driven by just a few companies that all share similar market cap, sector exposure, and valuations. And with the expected returns for the market cap weighted S&P 500 now projected at about 5.5% a year, only a couple points above what we're getting in the treasuries. Or right now, I've seen in the CD market, you can get a 5.5% for a 30 day, which I did buy some.
Mm-hmm.
U.S. Treasury diversification may be more important than ever and may require an active approach to portfolio management, which is what we talk about all the time. Is if you just set your money and let it go on autopilot, what happens if we get into an area or a market where we're down or non-performing for 12 years? Can you afford that? Okay.
No.
And that's what we look at on the Platinum channel with not only Kerry's cheat sheet, but with our swing trading, our technical analysis to help
Yeah.
people, understand that money flows to where the value is. And if you think that uh, hedge funds and big money markets and family offices don't move their money around, you're crazy. They do. They don't
Yeah.
leave it and just set it. Okay. Your financial advisor may do that because they're lazy. Okay. And you'll go in every year and you'll have 20 different things, at $3.50, and you'll say you're well diversified. And then you'll get your statement and you made 2.4% and the market was up 35%.
Yeah.
Okay. Tell me that's right for you. Tell me that they care. Okay. They don't.
I think, it's interesting. I think they have good intentions, but they just don't know better.
I think
It's
it's
just
part of,
easy.
you were in the business. It's asset
Yeah.
gathering. Bring me more assets, put them in and let them roll. If
That's
someone
it.
asks a question, go service those accounts. If they don't, just let it sit.
Yeah.
It's like renting a storage unit. You just, as long as you keep paying it and it doesn't bother you, you just keep
You
taking the
ignore
money.
it.
Yeah,
Right.
exactly.
I think I'm looking at what's happening. And as you were talking about statistics on the S&P and the weighting of 35% within 10 companies, 20% within 3. Going back over history, I believe you can find these patterns where certain industries explode. Prior to the internet world explosion in the 90s, what were those industries? Was it oil and gas? Was it consumer staples, consumer discretionary? And when you see that pile up into one sector, it's a telling indicator of what is the institutional money is piling into and pushing higher. And then you follow the news, especially today, in compare way different than it was, say, pre-internet. Now the internet is pushing these numbers, CNBC, Fox Business, what have you. And I think this is where you start to look at this and go, okay, you got a big push since the bottom of 22 into this into tech, but really into this microsector of semiconductors. And you can
And
see that
even more micro AI.
AI. Okay. And we have seen this massive push through 2023 and now into 2024. I look at Nvidia probably not today, but it's been as high as 144% year to date. I
Yeah,
mean, that's not real, folks, right?
that's not really, yeah, that is not the norm.
It's
Okay.
real. Well, first of all, let me correct myself. It's real, but it's not sustainable. It will
It's
come
not,
to an end.
yeah, and it's not the norm. Yeah, it's at
Yeah.
some point we will see something happen. Okay, it's just like you said, things don't go up forever. They just never do. Okay,
No.
gravity will bring it back down.
Yeah.
So,
And I think that's in a sense what we're seeing,
well,
with
let's just let me go through the top 10
yeah, go ahead.
stocks, and we'll see who they are. Who do you think number one is? And this is just through June 2020, and that changes because especially these days with the prices going up, the
Right.
top three are rolling around. But Microsoft represents 7.21%. Okay, so if you have
Of
a
the
move in
S&P 500.
of the S&P 500 market cap, market weighted,
Okay.
Nvidia is 7.03%. Of course, these two have been bouncing back and forth higher.
Right.
Apple 6.63%. So those three are just under 21% of the market cap. Okay, what sector are they in? Tech, tech, tech. Okay.
Right.
Who's number four? Amazon, 3.7%. Who's
Yeah.
number five? Meta, 2.4%. Who's the next one? Google, and this includes Google L and Google, okay,
Yeah.
4.6%. Okay. And then what's next? Broadcom, AVGO, 1.66%. So there's eight, and they're all in tech.
Wow.
Okay. There are two that are not. Berkshire Hathaway, yay,
Yeah.
at 1.62%, and Eli Lilly, who has been on fire, at 1.54%. So highly tech oriented, highly tech, So again, history shows that that's not a good sign.
Right.
So enjoy it while we have it, I guess is what I'm saying. But if you think it's different this time, I'm not sure. I'm not sure it is.
It's not different. It's never different. I
No,
the housing boom. I had friends of mine tell me, "Oh, this is just going to continue to go through the roof." I'm like, "Dude, you're worth 8 figures in 2 years. Really?" I mean, it doesn't it's a cycle. And I think it's interesting you bring up Eli Lilly. This is pharmaceutical healthcare related, correct?
yep. Well, it's mostly because of their weight loss drug,
Okay.
and I think they have some
Is it
Alzheimer's stuff coming up too.
is this a sign of a rotation into healthcare in the coming year? I mean,
Well,
when you see these cycles like we've seen over the years, where is, when we've had the tech cycle, the housing cycle, now the tech cycle again, going back, what is the historical defense rotation in the S&P?
I guess we'd have to watch by market cap, what moves in and what moves out.
That's
Okay.
interesting. Yeah.
So I want to show you one more chart just to kind
Yeah.
of close on what let's see here. And this is just a chart showing the divergence we're seeing in the equal weight S&P 500 ETF and the market cap weight, the SPY. This is the SPY right here.
Okay.
Okay. And since about May 30th, the end of May, you can see we've started a divergence here. This is the equal weight, the RSP. And you can see, yeah, the market cap weight went up and the equal cap weight kind of went sideways to down, while we're seeing the market cap weighted with the top 10 representing 35% up. This is a divergence. Okay,
Mm-hmm.
so this tells me the market's not healthy. There are
Yeah.
10 companies that are really healthy, plus a few others. Okay. But if you are in the SPY and you think that you're diversified, among 500 companies, you probably aren't. You're probably more diversified in the S&P or in the RSP, which is the equal weight. And if you're in the equal weight, you're not performing quite as well as you would see in the SPY.
What would be interesting is to look at past bubbles like the internet bubble and look at the equal weight versus the SPY and where would you be safer, I guess, during that downturn, or is there not even a safer place?
Well, it's kind
Does
of
that make
interesting if you
sense?
look. I mean, let's just look. They've kind of correlate.
Yeah,
And here was the pandemic.
yeah.
Okay. And they both went down. And then it just kind of went parallel,
So really
sideways
not
down,
much.
sideways. And right here
Yeah.
is where we're seeing the divergence. We don't really see it. Let me see if it'll swing me back. We'll buy it.
I mean, historically, it doesn't look like they diverge away from
No,
each other
no,
until here recently.
yeah. Mine won't go back to the pandemic or the Great Recession,
Yeah.
but you can see they mostly stick together
Huh.
until now.
So what's
And
interesting.
and not only is that, I mean, look how close they are, even on this wide picture,
Yeah.
up, down, nope, stop moving. Um, and then all of a sudden, look how far apart we are. That really hasn't happened too much from what I see on this chart.
I honestly think this is a lot of leverage and a lot of derivatives. When was that pivot? So that was 23. Looks like November of 23 is where your wedge starts.
Oh, right here.
When
That's
did
about November. Yeah.
when did 0 days to expiration options start?
Ooh, I don't know. I'm not sure.
I'll look it
It was
up.
probably, I don't know. You might be close.
Let's see. The boom in stock options known as 0 day to expiry or ODTE started in 2022. Yeah, so that was the beginning of them. And I think,
22 is way down
yeah,
here somewhere. Oh, here. This is the end of 22,
okay.
right here.
So they became available in a bigger way. Because if you think about it, if you buy an option that expires the same day, that's a 0 day to expiration option. But the popularity of them really, I think, exploded in probably 2023.
Well, you knew, like, I mean, you used to do them, or you still do. I don't know, but
No,
yeah, it wasn't that long ago when you were
yeah.
playing
So
around in
they
that
in
in that field.
2023, they represented 43% of the total S&P volume by time to expiry. That was when was this printed? This was August of 23. This article was printed. And I'll put this chart up as well here. Yeah, in 2022 they were 36%. 2021 they were 21%. So they've doubled. Well, they doubled according to this chart up until August of 23. Basically, they doubled in the amount of volume. I can't imagine what they are today. And if you think about the divergence from the equal weight and the SPY in the last since November,
Yep.
this could easily be heavily influenced by these 0 days to expiration options. The volume behind them and the interest behind them has become massive. And
But you're right. You said August.
yeah, according to this, they represented 43% of the total SPX volume by day to expiry.
Yep.
Yeah. Yeah. So they
August is
represented
about in here.
43% of the volume. And this is as of August of 23.
It's really interesting because right in this area here at the end of 2023, again, we started seeing the breakout of the Mag 10 and all that. And you're seeing a divergence here
Yeah.
between, and then we had the dip, and they both dipped. And then since that time, we just continued on with the divergence
Yeah.
between the equal weighted. And so, this market, technically, when you look back here, I mean, this was the start of the year. At the start of the year, it became really a 10-horse race, maybe a 3-horse race now.
Yeah.
And you can see the effect on the market. And you can even see, it's just getting further apart, even more than it was before, our little dip that we had back in April. But again, it's not getting any better at this point.
No, and I think it's actually getting more dangerous.
Yeah, it probably is. And that just shows, again, we're at over 35%. And when I showed you that chart earlier, that's as high as it's ever been. Okay.
Yeah.
So so all it takes is a couple of hiccups in one of those, or 2 or 3 of those top 5,
Oh, yeah.
and you're going to see trouble. Okay.
Yeah. And you just
Unless the rest of the market picks it up. And then that's when you start looking at the things we talk about that are macro, credit card debt, consumer
yeah.
spending, inflation, purchasing power going down. All those things are what you're seeing, I think, in the equal weight, which are smaller companies at the end. And if you even look at the Russell's not doing well. And those are the ones, if the economy is really picking up, you'll see it happening in the Russell first.
Yeah. And I mean, the Russell has struggled for years now,
Yeah.
which is a great, a leading indicator of how the economy is doing real well. Not to be negative or anything towards my old broker dealer, but saw this post with their economist who I know. He's a really good guy, but the question to him was, you know, how is the economy? Will the economy continue to still do very well like it's doing now? And after taking a 3-week road trip across the country and seeing how a lot of people live and a lot of different conversations about the economy, I'm like, where are these people coming up with this economy's good?
Yeah.
You know?
Well, you just
And
got to
and
live
it
it.
and they're looking at here's the thing, they're looking at these government numbers, they're all manipulated. It's not really truly what's happening.
Nope.
Anyhow.
This is Russell versus the SPY.
Oh
Same
wow.
thing.
Yeah.
Small
Wow.
cap versus the top 10, basically. Okay, so let's put in let me take I bet they look almost the same. Yeah, look at that.
Wow.
That's equal weight. So basically the equal weight S&P is tracking along with the Russell 2000, whereas the others that you're seeing, the top 10 in
Yeah.
the macro weight, it just shows again, we're highly concentrated in
Yeah.
few stocks. Okay, so it's like gambling all your money on every, that you're going to hit black, at the table, and
Right.
you're just all in because it's been winning. And the rule of numbers will come around in and punch you in the mouth sometimes.
Yeah. Well,
So
and I think,
I'm just saying, as an investor, as a trader, with your own money, be aware. And is your financial advisor aware, or do they care?
I, yeah, I think at the end of the day, it's sort of like, it's really easy to look at what's happening. And when you understand the facts that 20% of the S&P is directed by three companies, one of them is up 144% or was at some point this month, year to date. When you start to realistically, if you can take the emotional hope gland out of your brain and just look at the facts, you start to see really what's happening. Take into account a lot of other element variables that push markets, like the big explosion in options markets to derivatives and how those work and how they propel a stock. They can also do the same thing on the reverse side. And I think this is where I really hope people can put hope aside for a while and, and just look at really what they got, because I I don't know, I look at this and I go, we're repeating the same thing we've repeated the last 3 or 4 blow ups I've been a part of, you know. It's the same behavior, the same attitude, the same news stories, same narratives, the same, oh yeah, but look at the market's gone up for the last 100 years. I'm like, has it? You know?
Well, this again, this is the highest. I mean, when you look at our debt as a nation,
Yeah,
our debt as states that don't have, balance the budget amendments, you look at the debt in the publics, okay, the highest debt in credit card. We're looking at high delinquencies going up in credit cards and in cars. Okay,
yeah,
so when and if that hits the housing market, and how will it hit the housing market? When people start losing their jobs.
yeah,
What's the Fed trying to do? Get employment up to slow the economy down, slow inflation. How do
right.
you do that? People lose jobs. If you lose
Yeah,
jobs, you don't make your mortgage payment anymore. And we'll see what happens.
yeah,
So that's the last leg on the three-legged stool, I think.
yeah,
And if you look, those numbers again, even Fed Powell's chairman said, those numbers are a little wonky. He didn't say that word, but he said that in you know, his last press conference. So even they know, that the household survey, uh, and then the establishment survey just don't mix. They don't
yeah,
match. They tell two different stories. Something's up. Okay.
yeah, yeah. So I wanted to show just one thing. Um,
Yep.
okay, so this is the China Global, China Global and Shanghai Export Container Freight Index. What this measures on a weekly basis is the amount of, basically the cost of shipping contents from the Shanghai, China region. And what you can see here is the cost in shipping has has started to go higher in a bigger way. Specifically, the Shanghai, which is the red line, since the beginning of 2024. When this index is showing an acceleration in the cost of shipping, that does not translate over into our consumer price index, or CPI, for as much as 6 to 12 months. It is projected, and this is based on information from a research firm I subscribe to, that they anticipate that the CPI, you will see shipping will represent in January 80 basis points of the CPI number. So if based on that, if this number continues to rise in the cost of shipping between now and the end of the year, we should see a significant bump in the weighting of the CPI when it comes to shipping. If you go out a year, so a year from now, it'll represent 1.6% or 160 basis points of the CPI movement in the number. And what basically this is saying is inflation will go up because the cost to move goods from manufacturing in China, Vietnam, and these other um, Asian countries to the United States is going to accelerate, which then brings me back to, will the Fed raise rates or lower rates, or will they hold them, or will they raise them? And I am starting to believe by next year at this time, and I've said this before, I believe the Fed will have to raise rates again. And we will be in the environment similar to the 70s. And you've stated this in the last two regular guys show about stagflation. And chances are 2025 will be a big year of rising inflation, rising rates, which translates also into slowing housing, which I'm seeing in my area. You're going to see slowing housing, a rising cost in real estate, in rental real estate, and then goods and services as well. And so I believe this is something nobody really talks about in shipping, is what it costs to move a product from around the world to us. This is something that I think is a big influence on if we will see the Fed raise or lower rates in the coming 6 months or even next year. I'm on the opposite side. I think they will raise them, which
I don't think that inflation is done yet.
no.
Okay, and all you got to do is go to the grocery store. And Janet Yellen said today, she was being interviewed by someone, I don't know if it's CNN or Bloomberg, and the lady who was interviewing her said, "Well, have you been to a grocery store lately?" She goes, "Oh, I go every week." She says, "So you see all the sticker shock?" She goes, "No, I don't." Janet Yellen doesn't see, she doesn't see it. Okay, well, maybe because she makes so much money and she's a multimillionaire, that doesn't matter that cookies went from, or my favorite little chocolate donuts, went from
Right.
$2.50 to $7 now. Doesn't
Yeah.
affect her. Okay. This chart here is something interesting. And again, it goes to what you're saying about inflation. This is the USO, okay, United States oil. And this is last month. This is May in this box here.
Mm-hmm.
And this is the price of oil. And then this is June. Okay, so we just had the CPI and PPI come out, and everyone was joyous. You can see what happens in June, and we're not done with June yet. The price of energy is now rising. This will be reflected in next month's for the June CPI, PPI.
Yeah.
Okay, so if you think we're done with inflation, that's not what I'm seeing in the charts, and that's certainly not what you just saw in shipping.
Yeah. I think these are areas that directly affect us on a day-to-day living standard, and I think this is where you look at a company like Apple, who manufactures overseas, that they have to ship all that product here. It's going to cost more. So their hardware or hard goods are going to possibly see a dip, and they are what, number 3 or number 2 biggest company on the S&P 500. So this is where that market capitalization effect really could get accelerated in the S&P. And as they come into earnings for second quarter, when they report in third quarter for second quarter earnings, we could start to see that the comments from their calls about looking at the next quarter or 2 quarters, even 3 quarters, that there's going to see an increase in cost of goods, but also a slowing in goods. And to me, pushing the pushing the boulder over the cliff in a sense.
Well,
So
I'm not an Apple follower, but haven't the last several quarters been disappointing as far as earnings growth and all that with Apple?
pretty flat. Yeah.
And then when you look at it, okay, so now my phones are going to cost more with consumers already strapped, okay, and their debt as high as it is, and they're just cutting down to the basics of food and energy and transportation. Who's going to go out and upgrade to a new iPhone?
I don't
Okay,
think they are.
we have a society where it's two classes basically: those who are being hurt by inflation and by pricing power, and those who are not. Okay, and that's where we're seeing it. Those who are not are on CNBC telling us how great it is, or in the government telling us how great it is. And those who are regular guys like us are like going, I don't see it.
Right.
I don't get it.
Well, I think it's important to take into account a person's motives. Janet Yellen didn't say, I don't see inflation, because if she said it, all crap would hit the fan, right? She can't say she sees inflation. She knows it. She's a smart lady, but her job is to keep everybody happy. And since we're in a presidential election year, that may have something to do with it as well. The guys on CNBC, if they came out and said, yeah, my large cap growth fund is going to start tanking because the companies I'm invested in are going to start feeling inflation and slowing down, well, that guy doesn't get his bonus check at Christmas. So
No,
I think that's
no, I get
where
it.
it's, huh?
I
I,
get it. Yeah.
yeah, I mean, I think it's important. This is where Best of US Investors, the Platinum Channel, Kerry, you and I look at this and go, let's look at the truth. Let's look at really what is happening and how it's affecting me and you and everybody in America on a daily basis, and then use that information to capitalize and create wealth. And that's what this is about. If you're naive and just going to stick your head in the sand, well, that's the dinner you're going to eat. you know? So,
Not only to create wealth, but to preserve wealth too. Okay. Because that's just as important as making wealth, is making sure you're not losing. Because if you lose 50% of something, your stock value, Nvidia goes down 50%, it takes 100% of a gain to get you back to even.
yeah.
Okay. So that's not where you want to be.
And you have variables that took you down can keep you down. And
Oh, yeah.
that's the thing I see in the Discord, I see on some of the calls, the wins that our tribe members are having. My only concern about it is know when to fold them. Know when enough is enough.
Well, and I think
You know,
that's a big lesson in our technical analysis and swing trading is, again, it's not how much you make, it's how much you don't lose too,
right?
and cut them, fish or cut bait, is what they say. We cut bait on the losers and we fish the winners.
Yeah,
Okay. Well, it's like deadliest catch. If they aren't getting anything in their test pots, they pull up and move somewhere else.
yeah. I went fishing years ago with my father, my two uncles here, just out of Grayton Beach, Florida, and the captain said, we're gonna, if we don't get a bite within 2 minutes, we're out of here. And he kept on hopping around. Within 4 hours of us being out there, we had a day trip. We were so worn out because we caught so much fish. We said, forget it. Let's just go in. And
Yeah.
that's the same way with this is if you're seeing like Nvidia, a turn or a downturn, you're seeing weakness, take your profits, cut bait, go.
Well, it was like today's watch list, charts of interest. Um, and I try to find some every day. Today I didn't find one. Okay, I didn't find one chart that interests me at all,
I
and so I
know.
put it in. Sometimes you just got to be patient, and if it doesn't compute, stay out. Just watch. Well, the markets are just kind of doing nothing today, down to nothing. And
Yeah.
so why would I want to try to gamble and try to make anything out of a market that's telling me, this is not a good market for you to be in right now. Let the markets tell me when to get in, and that's when we get in. And then they tell us when to get out, and that's when we get out.
Yeah. Let markets come to you, not you to come
Yep.
to them.
Yep. I don't chase
Cool.
them. I don't chase them. I just follow. I just watch them.
Well,
What the
you do
charts tell us.
well, you do a good job. So we appreciate it. But well, I think that's all I got.
Yep.
Um, watch
You did
watch your
well.
back.
Your voice held out through the whole
I
time.
I know. I feel like my eyes are about to swell up, but yeah.
And
But but I'm at the end of it. I'm at the end of it. It's coming to an end.
good.
So,
Well, until next week, we'll look at it something else next week and see what happens. But other than that, we're just two regular guys trying to live our lives, and we have the Platinum channel, and our Platinum Zoom call is every Friday, just about every Friday at 11:30 Central, and people get on. We ask questions. We go over markets. We talk among each other about, what's the price of gas in Oklahoma compared to Connecticut, and what are you seeing in the housing market? And it's really enlightening for anyone who's an investor or a trader.
It is. And I think most importantly, it's you learn something. And that's the common theme. It's community. You get to share ideas. You get to, chop them up, make them into a better idea, and put them to work. And so that's what we're all about.
And it's very unique, in the YouTube Discord world, that we become accessible to each other, and we almost are a family, and we
Yeah.
get to know people, and we get to know their likings. And, I like horses and I like chess, and some people like guitars, and they tell us about that. And it's good to see when they can make some money and go out and spend a little on dinner, or spend a little on what they're what they
Yeah.
like,
And build wealth. Build
and build
wealth.
wealth and
Yeah.
not lose wealth. Yeah.
That's right. All right. Well,
All right.
I'm Trent. This is Mark. We're two regular guys. Join us next week. In the meantime, have a great week. Trade safely, invest safely, and keep your eyes open. We'll see ya.
And cut.
Cut.